Ladies and gentlemen, good day and welcome to the Mahindra CIE Q1CY22 Results Conference Call hosted by ICICI Securities. As a reminder, all participant lines will be within the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Basudeb Banerjee from ICICI Securities. Thank you, and over to you, sir.
Thanks, Margaret. Good afternoon to all participants from India and Asia, and good morning to all participants from Europe. We are grateful to get the opportunity from Mahindra CIE management to host the call. And I'll welcome the management represented by Mr. Ander Alvarez, CEO, Mr. K. Jayaprakash, CFO, Mr. Vikas Sinha, VP Strategy, Mr. Lofon, Business Controller, and Swapnil Saudagar, DGM Strategy. So over to you, Vikas, and for the initial comments, and then thanks.
Thanks, Basudeb. Good day, everyone. Good afternoon, and good morning to those who are joining from Europe. I welcome all of you, as well as Ander Alvarez, our CEO. So we are going to talk about our results for Q1C22. We start with Mci India Results for Q1C22, the first quarter of calendar year 22, which is on page 6. Sales is 15% higher on a year-on-year basis compared to Q1C21 on a year-on-year basis. However, this is mainly due to RM price increase. If you look at the table on the right that depicts market performance, you will notice that the light vehicles, tractors and two-wheeler segments all experience negative growth vis-a-vis Q1C21. Mci India's sale performance is thus better than the market even after taking into account the RM increase. But the table also presents signs of optimism. The performance of light vehicles and tractor segments is better than in the Q4C21. So sequentially, tractors and light vehicles are better, and we expect this trend to continue. MHCV quarterly data is not presented, but they are also improving steadily. Only two-wheeler segment shows some cause for concern. Despite this uncertain market scenario, we are happy to report that in Q1C22, we have returned to our target level of 15% Ebitda in India. Sales in MCIE were rupees 12,022 million with an Ebitda at 15.1%, EBIT at 11.2%, and EBT at 11.0%. This is evidence that proactive measures like VRS in the stampings business, which were taken in earlier quarters, are showing results. MCI Europe results for Q1C22 are shown on page 7. The sales here again have seen growth in absolute terms, but again this is largely due to RM costs which have been passed through without any margin. The Ebitda margins, however, continue to be affected by the higher energy costs which have been further exacerbated by the Ukraine crisis. We have been discussing on passing on some of these increased costs to our customers. Thus, the Ebitda margin is at 10.2%, lower by 3.7% compared to Q1C21, but better by 1.1% than Q4C21. So clearly this measure is helping. Q1C22 EBIT is at 7.0% and EBT at 6.5%. The forecasts for the European automotive markets made between January this year and April now have seen a sharp decline. We use the estimates from IHS. So the IHS estimates for C22 for the light vehicle segments were about 18.1 million units in January, but in the April forecast they have downgraded this to 16.1 million vehicles. It is now expected that European light vehicles will grow by 3 to 4% in C22 compared to double-digit estimates earlier. We will therefore continue to focus on internal improvements to tide over this. And now if we go to page 8, we will see the consolidated results, which are a combination of the evolution in both India and Europe. MCI achieved a sale for the quarter of rupees 24,444 million with an EBITDA of INR 3,079 million, which is 12.6% of sales, and an EBT of INR 2,130 million, which is 8.7% of sales. MCI consolidated performance is better both on a year-on-year and consolidated basis. And in fact, Q1CY22 results are one of the best quarterly results that we have ever achieved in our history. Also, all other three key projects that we had outlined in our year-end C21 results call, namely EV orders, digitization and automation, optimizing energy costs in Europe as well as in India through renewable power, they are all progressing well. So we can report good progress there. Therefore, we are focused on maintaining this good momentum in performance, and this we are doing it in an uncertain and volatile market, and we hope to be successful. So thank you, and now we proceed to Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Pratik Kothari from Unique PMS. Please go ahead.
Hi, good afternoon. Because in the presentation we have mentioned that we have passed on the raw material prices without any margin. But if you look at our, and there's no volume growth if you compare to the last year, but if you look at our gross profit, we are seeing some substantial growth from 1,200 crores last year to 1,400 crores now, and even gross margin in percentage terms remains the same. So how do we look at this number then?
Okay. JP, would you want to take this? This is, I think you are talking more in terms of a European business, right?
No, I'm looking at a consolidated basis, the one which I reported to CB. So if we pass on the raw material prices without any margin, then the absolute gross profit should have remained the same, but that has also gone up 15-17%.
Yeah. So that, a large part of the sales is accounted for by raw material prices, but not all of it is accounted for. A large part is accounted for. So there are a lot of efficiency improvements also. We talked about, say, for example, we had done VRS in India, so that is taking an effect now. Plus, there have been other projects that have been going on, which we have been talking in general. We have been doing a lot of work on digitization, automation in India. That has been going on. So it is not that, when we mentioned that comment, that was made more in terms of sales in Europe, where, the expansion is quite substantial. Large part of it, maybe 2/3 out of it is coming out of, RM growth, but the rest is coming out of a mixture of factors like improvements and product mix, different segments are growing differently, all that. So it is not entirely due to raw material. That's the reason why you're seeing the increase in gross profits.
Fair enough. So in a normalized times, maybe few quarters down the line, when we are able to pass on this raw material prices at margins also, given the improvement that we have done in-house, there should be some substantial jump in the numbers we are reporting. I mean, this seems to be a massive improvement in our internal efficiency.
Yes, there will be an impact when the steel prices stabilize. Yeah.
No, good. I don't know, because I think, Mr. Kothari, I hope you have understood this properly. What we are saying is, when you have steel price increase which is passed on and there's no margin improvement, but your point is valid that despite that we have a gross value addition of almost 2 billion if you compare year on year.
Yes.
And your question is, how did we achieve this 2 billion when volumes are not really growing? So we cannot say that the volumes are not growing, because we had a 20% growth year on year, approximately, let's say 10 to 12% would be the steel price impact. So we've had a volume growth in India and to some extent in Europe as well. So there is that contribution of, I think if you're looking at 2 billion, we can look at half of it or a little more than half coming through this volume increase. The rest would be definitely improvements, both on productivity. There will be some mix impact because different businesses have different value additions. So when that mix changes, it impacts. And lastly, some price increases that we could have probably got. So it's a mix of all these three that the rest billion accounts for.
So this incremental volume that we have seen of maybe 5 odd %, that is it in some very different segment, something very high value added, or is it business as usual, the products that we used to do earlier?
Mostly, like for example, in India, the four-wheeler segment has done better than the two-wheeler segment or the tractor segment. The four-wheeler and truck segment has done better. So depending on what product, so there will be some impact like that. So it's not as if, something has changed suddenly. It is just that, some segments have done a little better than the others. So that's about it.
One noticeable one is, of course, metal gas flow in Italy, which is doing much better. So if you may just point out.
Yes.
Okay, fair enough. And my last question on this other expenses, from 500 odd crores quarter-on-quarter, year-on-year, we are up to 700 crores. So what would define this?
Essentially, this has variable cost and most importantly, the energy cost. And the huge jump in energy in Europe plays a significant role in this increase.
But the energy cost, I believe, was, at least in the past, used to be about 110 crores a quarter. Fuel, power and fuel costs.
It used to be about 5 to 6.
Yeah, about 450 crores a year, which is 110 crores a quarter.
Yeah. So in Europe, it has almost more than doubled. So that's one impact that is significant there.
Okay. So this is largely variable.
Volume related, because subcontracting, and there are other variable costs which go and sit there, so which are volume linked.
And we are yet to pass on this prices.
We are yet to, and some progress has been made, but I think there is more to be passed on if it is possible. Yes.
Normally these costs are not passed on, but yes, because in Europe this has been a very special case. That is why this exercise is on.
Fair enough. Fine. Great. Thank you so much and all the best.
Yeah. Thanks, Pratik.
Thank you. The next question is from the line of Noel Vaz from Asian Market Securities. Please go ahead.
So I just had one query. So regarding energy costs. So compared to
I'm sorry to interrupt you, Mr. Vaz, but your voice is breaking up. Can you please check your phone connection?
Okay. Can I be heard now better or?
Yes, better.
This is better.
Yes. Okay. Yes. So typically, cost tend to be about 4.5% of sales. Now, in CY21, given the fact that in the fourth quarter we had seen a spike in Europe, it's gone to about 5.4% for CY21. So I think, so what kind of an increase can we expect in CY? Power rates have already remained quite elevated for now the first 4 months in Europe. So are we expecting to see some kind of a reduction in the second half, or what kind of movement can we expect to see on that front?
JP, what is the expected power cost in C22 as percentage of sales?
I think his question is, in Europe, what do we expect going forward on the energy? I think Ander probably can answer that. How does the energy cost look for the rest of the year?
Okay, it's very complicated. Good afternoon, everybody. It's a very complicated question, but I will try to give you my view on that. Okay, the energy costs were up in Europe since approximately summer last year, August, September. We already saw certain increase on the gas prices and also the electricity prices. Okay, these energy price increases continued during the last quarter, and this affected us importantly, especially in Spain, in our Spanish plants. Then in the Q1, due to the war that we have in Ukraine, the energy prices peaked again, and we are now electricity is approximately at 200 250 euros per megawatt, and the gas prices in this moment are at approximately 80 euros per megawatt. So we see these high prices will continue during if the war continues alive. Okay, so our view, our energy prices will go down slowly during the next quarters. It will depend heavily on the evolution of the war in Ukraine, so that will be probably the key factor that will generate the price reduction. But we are optimistic on that, and we think that during the year the prices will go down to the normal situation. If you look at the futures of the energy, they are already highlighting a certain reduction for calendar year 23, and from 24 onwards, energy comes back to the normal prices. Okay. So, generally speaking, I think that we can say that we had a very bad Q1. We will have a bad Q2 also, let's say at the same level than the Q1 probably. And from that point, I think from Q3, Q4, we will see a certain reduction. Also, I think it's important to say that the different governments in the European Union are taking measures to reduce and to control the price of the energy. So I think we will be benefited for that political actions. Okay, so overall, we can say that we are now in the worst moment of the energy prices. Also, we are negotiating with the customers to pass through these energy cost increases to them. During the first quarter, we settled certain agreements with them, not just a minor part of the customers, but we are in negotiations, and let's say all the automotive suppliers in the industry are dealing with the customers in this sense. Okay, so we will see a certain improvement in the next months, and we are positive, we are optimistic that we will close agreements with all our customers in the next months. Okay, so that's the general view of the energy in Europe. Thank you.
I think that was my question. Yeah, that's all from my side.
Thank you. The next question is from the line of Jinesh Gandhi from Motilal Oswal Financial Services. Please go ahead.
Hi. A couple of questions from my side. Firstly, in India, we have seen a fairly strong growth as compared to the underlying industry. So what has been the driver of that growth? I think except for passenger vehicles and to a certain extent commercial vehicles, all the segments were relatively weak for industry and for us. So can you throw light on what drove that 10% kind of growth?
No, if you, on a year-on-year basis, Jinesh, a lot of it will come from steel price increase.
Yeah, no, so I'm excluding that 10% in benefit which JP talked about. Even without that, it's another 10% additional growth which is there. So
in India, roughly we were 15, so it would be 5.
Right.
So what has happened is four-wheeler has done relatively better this year, this quarter. Trucks, unfortunately, we don't have data for trucks, so we have not presented it to you. Trucks have also done well. So these segments in which I think we have, even though trucks is small business for us, but one of our plants is quite dependent on them, like foundry. So there they have done well. And of course, we have been adding capacity in India, so we had the order books. We have been talking about, if you look at in C21, we had so much capacity expansion in India. In fact, our capex rate in C21 was higher than normal, and that was largely because of the investments that we made in India. So those order books were there, and that is why we have been saying all along that our underlying growth will be a bit better than the underlying market, and that is what is coming out in India.
Sure. And how has our exports revenue grown in the Indian business?
Exports?
Because just before the exporting, I think Mexico is also doing well, which is part of India segment. So that's one reason for growth.
Yes. I think this is Under speaking. Regarding India and maybe get also one of the clues, we include also our Mexican activity, that is Billforce Mexico, in India, okay? Because it's a subsidiary of Billforce. So in Mexico, finally, we are in this moment selling approximately at $2.5 million per month. That is the rate that we are. So we have growth, and we have doubled the business in 1 year. Okay, so there is a important growth happening in Mexico. That's also the reason that why we last year invested in the expansion of the building and also in the addition of new capacities in Mexico. So Mexico is doing really well. So that is one of the explanations. Also, as Vika said, I mean, all the verticals, especially in the four-wheelers, are doing well in India. And let's say that our sales could be much better if the two-wheeler sector and the tractor sector recuperates, okay? And that's why we are quite optimistic for the future, because we will not only keep this sales trend, but also we should be able to improve once the two-wheeler and the tractor sector recuperates, okay? Because you know that the two-wheeler is approximately 20% below last year, and tractors even more, even 35% below, okay? So once these two sectors recuperate, I think we will see a big jump in IL, in Billforce, in our magnets and our gears divisions, okay? So I think we can be optimistic from that point of view. And regarding Europe, in Europe, the market is also from the market point of view. We can say that the four-wheeler market is weak in this moment, and despite this weakness, I think our position is good. We are supported by the raw material increase, as Vikas mentioned, but also I think it's important to highlight that Metal Castello is doing really well. Okay, Metal Castello is getting now historical record on sales, thanks to the good performance on the off-road vehicle market in United States. Okay, and Metal Castello is growing approximately at a 35% rate compared to the last year. So that's why one of the supports to this good sales performance that we are having in Europe. Okay, and the rest of the businesses, Germany and let's say our CIE purchase in Spain, are maintaining the good sales trend, and we also expect to improve these sales in the near future, because the market, once the semiconductor shortage issue and the war in Ukraine are over, I think we will see a important jump in our sales. Okay, so I think that we can be optimistic in this regard. Thank you.
Okay, and any update on export revenues, how it has grown, and what percentage of sales now it is from India?
No, it remains fairly in the same range of 12 to 15%, because I think the domestic as well as export revenues are growing in tandem in India. So, as a proportion, it is not growing, but it is growing along with the other revenues, domestic revenues.
Got it. And for the European business, can you talk about the euro from the constant currency growth with and without RM and energy cost pass-through?
So under the question is, in Europe, if we change it into euro, in euro terms, and if we take away the impact of RM and energy price increase, what would be the growth?
At the moment we are calculating in euro, approximately could be the growth in Europe would be something like, wait a moment, about 10%, more or less, could be, okay? That would be the growth in Europe, in euro currency.
And this 10% is after removing RM and energy cost pass-through, or this is including that?
Okay, yes, eliminating raw material and energy costs would be the growth would be approximately 10%. Yeah.
Okay. Got it. Thank you. I'll fall back in queue.
Yeah, thanks, Jinesh.
Yeah.
Thank you. The next question is from the line of Nikhil Kale from Axis Capital. Please go ahead.
Yeah, thanks for taking the question. Just taking the previous discussion forward, you talked about the 10% kind of YY growth at a constant currency and removing the impact of RM and energy price. Would it be possible to maybe throw some more color on the different parts of the business? So, for example, what would be the growth in, say, PV projects and also the CV projects? I mean, would it be fair to assume that PV projects and even the CV projects will be broadly flattish and almost the entirety of the growth was given by metal customers?
Now, Nikhil, you were slightly unclear. Let me repeat the question for you and then we'll take it to Ander. So, did you say that you wanted to know that this 10% increase in European business, how much of it was coming from the different parts, CV forging, car forgings and off-road vehicles, right?
Yeah, that's correct.
Yeah, and so he's saying this 10% in constant euro terms, whether that growth from what part? Metal Castello obviously is the largest part, but what are the other? Are the others contributing to this growth or not?
Yeah, they are contributing approximately the same. Both in German business is doing quite well, and also passenger car business is doing well in terms of sales. So I would say that the best performer was Metal Castello, because in Metal Castello we have this growth, and the raw material impact is not relevant in Metal Castello of approximately 30%, and the rest is coming from Germany and from our passenger car forges in Spain. So I would say that more or less all the verticals are performing in a similar way, except Metal Castello that is doing better than the others.
Yeah. Okay. Thank you. Yeah. So just taking that point forward, if we look at the production data, at least for the less than 6 ton PV data that you have provided, that's down almost 20% YOY. So if we've seen kind of positive growth, just wanted to understand, is it the case that maybe OEMs have also built up inventory? And again, I reckon there would be also some benefit of some of the new order wins. So if you could just maybe talk about the same.
So, Ander, if again, Nikhil, I am summarizing your question for you. So the question is asking, in the car segment, there has been a drop in the market volume. So how have we grown? Is it because the OEMs are building up inventory, or is there some other reason?
No, we are not building inventory. I mean, he's asking for CIE or for the car makers?
For CIE.
No, I'm talking from car maker perspective. Is it that they are building up inventory of the other parts, whereas there are obviously some chip shortages that are happening, so they are maybe just building up inventory for the other parts of the car?
Okay. I wouldn't say that they are building inventories in this moment. We know that, for example, in Germany, certain truck makers, they are building the trucks. And they are not selling them because some electronic is missing, and there could be certain, let's say, balance in the next quarters, but it's not relevant. I would say that most of the truck makers, what they are saying us is that the order book is fully booked in this moment. I mean, they have more than 1 year of orders in the pipeline, and they expect us to continue producing at the maximum rate in the next months. Okay, so the information that we are getting from the market is quite positive in that sense. Okay, so that's the reality. That's why we are quite optimistic on sales evolution in the next quarters.
Okay, thank you.
Yeah, thanks, Nikhil.
Thank you.
Thank you. The next question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Yeah, good afternoon, sir. Namaskar. Thank you for this opportunity. Sir, firstly, if we take this other income component in our standalone numbers, how should one read into the operational profit on a standalone basis? So this is a one-off item that has appeared for this quarter of, I think so 89 crore as being...
That is Sorry, this is Jayaprakash. If you're looking at this quarter's number of 937, it includes 860 million of dividend received from AEL, which gets knocked off in consol. So in that sense, it is not relevant.
So sir, this component was not present for the last year comparable number.
No, it was not. No, this is the first time AEL has declared dividend.
Okay, so then even on a likewise basis, when we look at the console numbers, how comparable are these March numbers vis-a-vis the last year March?
So if we were to knock off that 860, we would be at something like 60 million, which is comparable with the previous quarter.
That's a small point. I'm just trying to compare March 21 and March 22. So March 21 did not have this other income component, correct?
No. So March we had 27 million. If
Okay.
we were to exclude this quarter's dividend of 860 million, we would be around 60 million, right? So there's an increase from 27 million to 60 million if you remove the one-time impact.
Okay. So this is the impact on the console number. The console number would have been lower in case if we knock off this extra dividend part.
Yes.
Okay, and what is the reason for this high dividend, sir? And what is the recurring? Would it be a recurring part? How has this dividend appeared for this quarter?
Mr. Kapoor, as I said, for consol it will not make any difference because it's coming from subsidiary.
Right, sir. But I only wanted to understand the nature of the dividend payout and how can we ascertain the continuity of the same in the 14th period.
But this will have only, even from a cash perspective, it doesn't have it. Since it is tax neutral, we have, AEL had accumulated cash, so that's how it has come. Going forward, there will be dividends probably, but we will assess it year to year.
And sir, the reduction in the finance cost, which we have seen on a quarter-on-quarter basis from 126 crore for the December quarter on a console level to 84 crore, 85 crore. How is this a sustainable number, and what factors have attributed to this significant reduction in the finance cost?
Okay, so this is not crores, it is millions. So it has come down from 12.6 crores to 8.5 crores. Okay? So this reduction, there are some one-time elements to it. There is a forex gain which has gone there of about 20 million. And the interest subvention was announced by the government in India in this quarter with a retrospective effect. So there is one-time impact there. I think I would rather leave it at the earlier quarter number for future projection.
Didn't get the last point, sir. Come again.
We had an interest subvention announced by the government, which announcement came in this quarter, but had a retrospective effect from 1st October of 2021. So there are one-time impacts. Therefore, if your question is whether it is sustainable, I would rather go by the last quarter number going forward.
The last quarter number, okay. And sir, for the energy cost part, as the CEO has mentioned, do we have any hedging mechanism wherein we are hedging our forward energy cost in some way or the other?
We don't have it, but I think he's asking if we are taking a longer contract.
So we don't have any hedging system for the energy. Okay, what we are doing now is we are negotiating with the customers, and we are looking for certain indexes to index this energy price to the peak price. Okay, that's what we are trying to do, and with, let's say, most of the customers they are negotiating with not only with us, let's say with all the suppliers, and probably in the next month we will see the certain agreements, and we will be able to offset part of this pain that we are having now in our accounts. Okay, you saw that our Ebitda margins in Europe were at 10% to 10.2%. That is far below that we had previous year, and the main reason of this drop in margins is coming from this energy that we are still negotiating with the customer. So we don't have any hedging system, but we think that we will reach an agreement with the customers in the near months.
Right, sir. Okay, sir, last point and then come in the queue. On the utilization levels front, sir, taking into account the order booking from the OEM part, what are the likely utilization levels for plants across our geographies? What have been for this quarter on an average, and what are we expecting in the coming foreseeable future?
Vikas, can you help me?
Yeah. So what the question is, what is the utilization level of plants in India and in Europe? Of course, in India, we have been adding capacity, so therefore that clearly is an indication that we are running close to utilization. So that is the question, what is the utilization levels in India and Europe?
Okay. In India, it's true that it's different in the different verticals, that we have different situation, but most of the businesses are running close to 100%. That's why we are adding this capacity, and probably we will have additional capacity of 20%, 25% in the next month once all the capacity expansions are in place. So India is in this moment at a high saturation, I would say, and in Europe we can be at in this moment at 70-75% of capacity utilization. Okay, so we still have capacity available to grow, but we don't see the growth coming until the war in Ukraine is over. Okay, so that's they say we will be able to keep this trend, and the growth probably will come once the war and the geopolitical frictions are over in Europe.
Thank you, sir. Thank you for all the elaborate answers.
Okay. Yeah, thanks, Sanket.
Yeah, thank you.
Thank you. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Thank you very much, sir, for the opportunity. So I just wanted to understand now in your opening remarks.
I'm sorry to interrupt, Mr. Poddar. Your audio is quite low. I would request you to come closer to the phone and the handset.
Yeah. Is it better?
Yes, this is better. Thank you.
Okay. So I was just looking any kind of outlook that you can share for CY22 in terms of growth or margins.
No, we don't make any forward-looking statements, but as you have heard Anders speak, I think we are pretty much optimistic both in India and Europe. Of course, a little bit more optimistic in India because the situation in Europe is a little bit unstable. But nevertheless, I think we hope to improve from here.
They hope to improve. So this 12.5% kind of a Ebitda margin on the console level, so that one can assume as a base going forward as we look to improve.
Let us not go there in terms of forward-looking statements. Please also realize that there is cyclicality in our business. There is in Q3 you will have in August you will have the holidays in Europe, and then we'll have the festive season in India. So those things factored in. As I said, we hope to keep improving from here. Let me not talk about what is the base rate and how much it can become. What we will say is that we want to be as close as possible to 15% EBITDA in the near term. That is the kind of the number that we are working with, and we hope to be higher than market growth. So these are the two things that we definitely are working with, and as I said, we are optimistic. You heard our CEO speak.
So just a clarification: this 15% you are saying for the India business or for the as a whole?
It is as a whole, but as I said, of course, in India things are a little bit, I must say, easier given that the market situation is less volatile here, but. We want to do it on an overall basis. Of course, Europe right now is at 10.6%, so it is it is a little further away. But what we are talking about is in terms of consolidated. That is something that we would like to do. Yeah.
Understood. Yeah, that's it from my side. Thank you and all the very best.
Yeah, thanks.
Thank you. The next question is from the line of Bharat Sheth from Quest Investment Advisors. Please go ahead.
Hi, congratulations in showing an excellent performance in challenging time to Ender and your team. So Ender, the question is now in India we have performed much better despite two-wheeler is not doing well. So and as also you said, some of the capex as well as new production line has also helped us. So have we gained some kind of a market share in other PV and CV as well as tractor, or even two-wheeler also, if one has to look at from that perspective?
I think that okay, Vikas, go on. Sorry.
No, Ender, over to you.
No, I was just going to mention that yes, we are improving our market share, and it's clear that we are affected negatively by the two-wheeler sector drop, and if the two-wheeler sector recuperates and the tractor sector recuperates, that's our expectation in the next quarters. We will see further growth in our companies, okay? But coming back to the four-wheeler evolution, just concentrating on that sector, yes, we think that we are growing our market share, and certain divisions, certain verticals like forging or like foundry, stamping, we are growing our market share, and we are recuperating the market share that we had before. So I think that in that sense, that explains our growth trend in India.
Same line, I mean, in Europe, if we remove metal cast alloy, which has performed much better, so in the remaining part of the business also, have we gained some market share, or it is the same where we were earlier?
I think in the rest of the business, we are in the same position that we were earlier. Okay, we don't see market share growth except in metal cast alloy, where our position with our American customers is very strong, and as they are performing well, we are also growing importantly. But in the rest of the businesses, in commercial vehicle forgings and passenger car forgings, we keep the position. No, there is no big change in there.
So, and question on now coming to this metal cast alloy, in earlier comment we said that we will be expecting now this year to go. What was the level we have picked out in CY2018 or 19 of 19 million? So what is current rate of metal cast alloy per month, and how do we see going ahead?
Okay, in metal cast alloy, we have this year the best historical sales in all the years that we know metal cast alloy. We were at a peak of approximately 70 million euros in 2018. This year we will hit probably 80 million euros. Okay, so there will be an important growth, and unfortunately we cannot sell more because our capacity is completely booked in metal cast alloy. Okay, so we will be at 100% load in metal cast alloy this year, and we are also adding certain additional capacity, but that will take some time. But we are quite optimistic on that sense. Thank you.
And is it a fair understanding, Jaiprakash, that because of metal cast alloy we have been able to improve QOQ margin in the Europe business, and once we get some kind of a pass through of the energy cost, so there is a further room to improve?
Europe?
Yes.
Yeah, I think I understood that, right?
Yes.
We have to get the energy cost across. It will.
And with metal cast alloy, which is a highest contributing margin business, because where the large part is our, job work kind of a, or machining kind of a thing. So overall, Europe margin will further improve, correct? Is that fair understanding?
Yes.
Yes.
Metal cast alloy helps.
Okay. And can you share, I mean,
Yes,
our cap? Yeah, go ahead, please go, Ender.
No, you mentioned properly. I mean, we are negatively affected in Europe in this moment by the energy and the inflation costs. Okay, those are the two impacts that are affecting us. And also, it's important to say that the raw material price increase without margin is also affecting to the margin. Okay, it's affecting between 1 to 2% on our margins, just for the raw material increase that has been passed through 100% to the customers. So those are the main impacts in our accounts, and it's true that we should be able to continue improving if we are able to pass through the energy cost to the customers.
Okay. And any new order win in the metal cast alloy do we have in this current year, or this whatever order book we have will be able to help us grow, I mean, even next year?
Not new big businesses. I mean, just small standard new orders, but not big ones to be highlighted in this moment. Okay. In this moment, what we are now preparing in Metal Castello is the plan for the future, where, as you know, we are at 100% of our capacity utilization. So, if we want to continue growing, we need to add additional capacity. Okay, that's the situation where we are having in Metal Castello in this moment.
So, and earlier, I mean, we moved some part of the order to India, and is it possible that with getting more order, we can move those part of the order to India in case of this capacity constraint is not really been resolved?
Yeah. The situation in the gear business in India, because you know that Metal Castello is a gears producer, and we have also the gear division in India. The gear division in India has been also in the last year at 100% of the capacity of the utilization. Okay, we were fully booked. This last month we are a little bit better because of the drop of the two-wheeler, but once the two-wheeler recuperates, we will be again, let's say, at 100% of the capacity utilization in India. That's why we are expanding our activity in Rajkot, where we opened a new plant, and we are now preparing that plant to continue growing. And also we are expanding our capacity in our Pune plant, where we will continue adding capacity to continue our growth trend. Okay, so it's a good point that you mentioned to use the capacity in India, but the point is that in India also we are fully booked in the gears division. Okay, so the expectations are very good in both regions, and that's why we continue our growth and capacity expansion strategy in both regions.
Okay, last question, Ender. On this FTA free trade agreement that India is negotiating with the Europe, happening of that, I mean, will it benefit Indian subsidiary?
Bharat, we'll have to study that. We have not looked at that, how the free trade agreement, if at all it happens or when it happens, will affect us. Please allow us to have a look at that, and then we'll come back to you.
Okay, and on the capex guidance for the current year?
JP, 5 to 6% of sales, but JP?
Yeah, I think it's 5 to 6%, yes.
Okay, thank you and all the best.
Yes. Yes, thanks, Bharat.
Thank you very much.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Nikhil Kale from Axis Capital. Please go ahead.
Just one follow-up from my side. On the RM price increase that you have talked about, just wanted to understand, is there also a component for, within that, is there a component for previous quarters, or is this pertaining to just this quarter?
Normally, all the RM, pricing, the steel price and aluminum price increases are settled within the quarter. Can we confirm that there was no steel or aluminum settlement from earlier quarters in this quarter?
No. I think you properly answered, because I think all the raw material increase in this quarter is coming from this quarter. There is no settlement. Just perhaps a small corrections in certain customers, but not relevant at all.
Oh, okay. Okay. Thank you.
Thank you. The next question is from the line of Jinesh Gandhi from Motilal Oswal Financial Services. Please go ahead.
Hi. My question pertains to European operations. For European operations, can you indicate what was the impact of unabsorbed or the energy cost which wasn't passed through in 1Q, and what further impact you expect in coming quarter?
Jinesh, you'll have to come again. Impact of unabsorbed?
The energy cost which has not yet been passed on to the customer.
So the question is, what proportion of energy costs have been absorbed and what needs to be passed through, right?
Right. And impact on this quarter because of energy costs on margins.
Okay. So under and Oroids, so the question is, have we, what proportion of our energy costs we have been able to pass on the increase? Say, like maybe all customers or 50% or whatever, that number. And two, what was the impact of unabsorbed, the energy cost that we were not able to pass through in quarter one? What was the impact on the margin? Whether it is 0.2, 0.5 or whatever.
Yeah, I think we passed through approximately 1/3 of the real cost increase. Okay, that can be the value between 25-30%. That's less than 1/3. Okay, that's what we have been able to pass through the customers. So of course we are negotiating with them, and probably we will recuperate part of this loss in the next quarters. Okay, that's the expectations. So, and the margin that we lost due to this energy increase, we can consider approximately 2%, 3% in Europe due to this energy impact. Yeah.
Got it. And
3%, that can be the impact that we lost due to the energy in the quarter. Yeah.
Right. Okay. And second question is for the India business. So on the steel price side, we have been seeing inflation even in 1Q. Do you expect further inflation based on where spot prices are continuing in second quarter as well, or you are seeing some stability in your procurement prices now?
Jinesh, I think the steel prices are still in an inflationary mode.
Yeah.
Okay.
We expect an increase in India, not in Europe, where the steel price has already increased, and we think that the price will be stable in the next months and quarters. But in India, there is some pressure to continue growing from the second quarter onwards. Okay, so we will see probably certain additional inflation in raw materials in the next quarters.
And any idea what could be?
No, it is yet not decided.
Sure.
But it will be
it's difficult to say. Yeah.
It will be double-digit. Okay.
Yeah, because mainly it's negotiated sometimes not directly by the customers, and they are still negotiating. So we are not aware of the amount that could be. Okay, but probably will be a certain increase by the next quarter. We will be able to see it in our sales.
Got it. And last question on the Mexico business. So it has seen a very strong evolution over the last couple of years. Now with monthly run rate at $2.5 million of revenue, do you see further growth in this business based on the capacity and the order book which we have, or the peak revenues would be about $2.5 million per month?
Yes. In this moment, we are at the peak of our revenues. Regarding the original plan that we have for this company, when we set up, our peak was at the current situation. So it took couple of years more than what we expected, but we are already there. But hopefully we got additional customers, so we are adding capacity, and we have a new press ready to be installed. In fact, we are in a setup mode in this moment in Mexico, and yes, we expect to continue growing the business in the next quarters. Okay, so we have already the order book is already confirmed from the customers, and we expect to continue growing in Mexico in the next years. Yeah.
Okay. So based on order book, should we expect revenues to further double from here in next 2 to 3 years?
Sorry, I didn't catch you properly. Can you hear me?
Based on the order books and the capacity expansion, over next 3 years, should this monthly run rate of 2.5 million further double?
Yeah, could be. Yes, that would be the best case, but the expectation would be if we are now at 2.5, probably having the company selling at 4 million per month could be reasonable. Even 5 million if we got new orders. Okay, but with the current orders, we will be not doubling the business, but growing 50-60%.
Got it. Great. Thanks and all the best. I'll fall back into you.
Yeah, thanks, Jinesh.
Thank you.
Thank you. The next question is from the line of Vasudev Banerjee from ICICI Securities. Please go ahead.
Yeah, thanks. A couple of questions. One, sir, in last quarter con call, you mentioned that there has been a sudden surge in EV two-wheeler related order book in India from select OEMs. I missed out. So any further development on that aspect this quarter?
No, it is continuing along those lines. So there is nothing very specific to report, but yes, booking EV orders is now an integral part of our working. So it is continuing.
And any new customer addition in the two-wheeler EV space as such?
Not to report in this quarter.
Okay. And second question would be very much repetitive, so sorry to ask it again. If you can again mention how much was the steel inflation YOY in Europe business, and how much was the pass on for that?
Yeah. JP or Oroids on, in Europe, how much was steel inflation, and, that was, one part of the revenues was steel inflation.
So 12% is the steel price impact on the growth, no? We mentioned that. Out of the 20%.
Yeah, out of 10% was because of inflation.
12%.
And commodity inflation for you was how much overall?
No, I didn't get that. Commodity
cost of steel per ton for you, sourcing cost, that's how much changed?
Oh, Orange, you would know that number. What is the steel price increase? I mean, it would be around 25%.
It has been around 10% last year.
Okay. And you're saying that still under recoveries are there, so there is some scope for under recoveries to continue to result in further price hike requirements. Other
not
than
on steel, not on steel.
Okay.
Steel is passed through.
And the power cost you are saying you are planning to pass through in the coming quarter.
Yes. Steel is passed through, power is still under negotiation.
Okay.
That's right.
Thanks.
Thank you. The next question is from the line of Raj Kumar, an individual investor. Please go ahead.
Yeah, good afternoon. Can you hear me?
Yes, please. Go ahead.
Yeah. So thanks for the opportunity. Congrats with good set of numbers. So I have just one question. Sir, given that, many of the auto ancillary units are not doing well because of the significant steel price increases and so on, and the other inflationary, trends, I just want to know what is your view on, will there be any further consolidation that is going to happen, particularly in India, and also if Mahindra CIE is looking at any, M&A opportunities in India?
Okay, thanks, Raj Kumarji. Of course, given the very volatile situation, the kind of scenario that you're painting can happen. But as we have mentioned in the past, looking for M&A opportunities is part of our, business strategy. But we are going to do an M&A only to fill strategic gaps. As you can very clearly see, we have enough order book, enough opportunities to grow in India. You heard how strongly we are growing in Mexico. Even in Europe, you saw how strongly Metal Castello is growing. Plus, when the war situation eases out, then the European light vehicle markets also we expect a rebound. So there is enough growth opportunities in our existing businesses. So any M&A that we will do, we'll do it very selectively, and we'll do it to fill up any strategic gaps or any specific capability, any specific customers that we want on board. So right now, we have our hands full dealing with, the situation that we talked about in terms of growth. But we keep looking for it. At this moment, we have nothing specific to report on the M&A side. Yeah.
Okay, sir. Thank you.
Thank you. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
Yeah. Thank you. And I'll hand you over to Anders for his closing remarks.
Okay. So thank you, Vikas. I just want to thank you, all of you, for your participation and for your interesting questions and your interest in our company. And I hope we answered the questions properly and accurately. Okay? And yeah, my message is that despite the difficult market and geopolitical environment that we are living in this moment, I think our company proved once again its resiliency and good management. So we were able to recuperate part of our margins that we lost last year, and we expect to continue this trend in the near future. Okay? And as always, I want to say thank you to all my Mahindra CIE team, that they are doing a good job with a good dedication, commitment in a very difficult times. So I'm sure that we will continue improving our results in the future. So thank you very much, everybody.
Yeah. Thank you very much. Have a good day, guys. Bye.
Thank you. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us. You may now disconnect your line.